Like Mike, who turned $100,000 of trapped equity into 3 new rental properties, you too can leverage your investment properties without income verification headaches. Today, I'll show you how DSCR loans let real estate investors access property equity, the qualification requirements lenders actually care about, and real examples of portfolio growth strategies. So by the end of this video, you'll know if a DSCR cash-out refinance fits your situation, how much equity you can typically access, and the exact approval process to unlock your property's value, information that could transform your investment trajectory. Income verification problem for real estate investors has always been an issue. You ever wonder why successful real estate investors with multiple properties still get rejected for loans? It's not what you might think. I've worked with investors who own 10, 20, even 30 to 50 properties, generating substantial monthly income, yet they still struggle to refinance or pull equity from their investments. Imagine owning multiple investment properties that generate thousands in rent each month, but banks still turn you down for loans. This happens because most real estate investors maximize their tax write-offs through depreciation, maintenance expenses, travel costs, and other deductions. While this strategy minimizes your taxable income, it creates a major obstacle when you need to access equity through traditional refinancing. When you apply for a conventional loan, banks primarily examine your personal income on tax returns. They want to see what you report to the IRS. This creates a problematic situation where your tax returns might show minimal income or losses despite your substantial rental income and property equity. Take Michael, an investor I recently worked with who owns 12 properties. His portfolio generates over $50,000 in monthly rental income, but after legitimate tax deductions, his tax return showed a $15,000 loss that year. When he applied for a conventional refinance to pull equity from his next purchase, the bank immediately denied him. The loan officer told him directly, according to your tax returns, you don't make enough money to qualify. This creates a frustrating contradiction. Your financial savvy and tax optimization actually prevents you from assessing your own equity. Traditional lenders have strict documentation requirements, typically 2 years of tax returns, W-2s, and proof of consistent employment, using qualification systems designed for W-2 employees, not real estate investors. The problem worsens as your portfolio grows. More properties mean more dedication and write-offs, further reducing your taxable income. Yet, this is precisely when assessing capital becomes crucial for scaling your business. Many investors face an impossible choice, paying huge tax bills just to show enough income to qualify for a loan, or miss opportunities to expand their portfolios. Some deliberately forego legitimate tax deductions for years just to show income for refinancing, while others attempt to work around like cross-collateralizing or bringing on co-signers, but these approaches have significant limitations. Hard money loans are available, but typically comes with high interest rates that eat into your profits. That's where DSCR loans come in. They're specifically designed to solve this problem. DSCR stands for Debt Service Coverage Ratio, and these loans ignore your personal income entirely. Instead, they focus solely on whether the property itself generates enough rental income to cover the mortgage payment. No tax returns, no W-2s, no income verification whatsoever. The property qualifies for the loan, not you personally. Now, how does the DSCR cash-out refinancing actually work? The calculation works like this. Take the property's monthly rental income and divide it by the monthly mortgage payment. So, principal, interest, taxes, and insurance, for example, if your rental property brings in $2,000 a month and the total mortgage payment is $1,600, your DSCR is 1.25%. The way we came up with that is the 2,000 divided by 1,600 equals 1.25. So most lenders will consider a DSCR ratio of 1.0 or higher favorable for approval. The 1% ratio means that the property's income exactly covers its debt obligation, essentially paying it for itself. Many lenders prefer a minimum DSCR of 1.25 for refinancing, giving them a comfortable cushion. Some lenders may accept ratios as low as 0.75, 0.5%, and even no ratio, meaning the property covers 75, 50%, or 0% of your monthly mortgage payment. With DSCR cash-out refinancing, you can typically access 70 to 80% of your property's value. The industry standard is around 75% loan-to-value, though some lenders may stretch to 80% depending on your application strength. So let me walk you through an example. Say you own a rental property appraised at $400,000 with a current mortgage balance of $200,000. With a 75% loan-to-value limit, you could potentially refinance up to $300,000, which is 75% of $400,000. And after paying off your existing $200,000 mortgage, this gives you approximately $100,000 in cash that you can access minus the closing costs. The documentation process is refreshingly streamlined. Instead of providing tax returns and W-2s, you'll typically need to submit current lease agreements, rent schedule showing the property's income, property insurance documentation, in some cases a 1007 rent schedule to verify fair market rent beyond the DSCR ratio ratio. Most lenders require a minimum credit score of 620, with higher scores securing better interest rates. DSCR loans do carry slightly higher interest rates compared to their conventional counterparts. That's a trade-off for a simplified qualification process, one that you can put into a limited liability corporation immediately from day one. The timeline is another advantage. While conventional refinances can drag on for months due to extensive documentation review, DSCR cash-out refinances typically close within 30 to 45 days, allowing you to quickly capitalize on new investment opportunities. So, with the quick 30 to 45-day timeline for assessing your equity, the real question becomes, what would you actually do with those funds? This decision isn't just about having cash on hand. It's about transforming that capital into substantial wealth. What would you do if you suddenly had access to extra capital to grow your investments? While many property owners immediately think about personal expenses, the truly successful investors approach this opportunity with a strategic mindset. DSCR cash-out refinancing offers remarkable flexibility, allowing you to direct these funds towards virtually any purpose you choose. The critical decision becomes, will you use the capital for immediate personal gratification or strategic reinvestment that builds long-term wealth? First, let's explore property improvements. Take the case of a savvy investor who invested $30,000 into a kitchen renovation that increased monthly by $300. This generates an additional $3,600 annually in rental income while simultaneously boosting the property's overall value. Kitchen renovations consistently deliver strong return, with ROI ranging from 60 to 80%, while bathroom upgrades perform even better, yielding returns of 70 to 90% in many markets. These improvements create more equity you can tap into during your next refinance cycle. Next, consider how reinvesting your cash can multiply your portfolio. This approach leverages your existing equity to expand horizontally, okay? For example, $100,000 in cash-out funds could potentially serve as a down payment on 2 to 3 additional properties, depending on your market. Each new property then begins generating its own monthly cash flow while simultaneously appreciating in value. This multiplication effect is precisely how successful investors rapidly scale their operation, collecting rent from multiple sources instead of a single income stream. The third powerful strategy involves debt consolidation. By using your cash-out funds to eliminate high-interest obligations from credit cards, personal loans, or private financing, you can immediately improve your monthly cash flow position. This creates more available capital that can be directed back into your investment activities, essentially allowing your properties to free up cash previously consumed by interest payments. The results of these strategies can be remarkable. Case studies have shown that investors who strategically deploy their DSCR cash-out refinance funds were able to double and even triple their portfolio within just 2 to 3 years. This exponential growth happens because each property acquisition creates new opportunities for further leverage and expansion. The timeline for seeing returns varies by strategy. Property improvements typically show results quickly, with most investors recouping their renovation costs through increased rental income within 1 to 2 years. Portfolio expansion may take slightly longer to fully mature, but the compounding effects create substantial, larger returns over time. Here's the exciting news. Home prices jumped nearly 19% between 2021 and 2022, creating a golden opportunity to tap into your property's skyrocketing equity through DSCR cash-out refinancing. This isn't just market data, it's your wealth-building moment. Act now. The perfect market timing is already here. Think of your properties as financial engines ready to fuel your next investment. Run those DSCR calculations today and connect with me and my team of specialists who understand investment property financing. Ready to move forward? Contact me and my team by clicking the link below to schedule a time to look over your home financing questions and concerns. Smart investors are already leveraging their equity to expand their portfolios while values remain high. Don't just collect passive income. Unlock your property's true potential. I'm 𝐬𝐻𝐵𝐺 Mortgage Guy, and I thank you for watching this video. Click the link below to schedule a time with me and my team. Subscribe, hit the notification bell, comment down below if you have any questions or concerns or would like to give me a topic for my next video. I'm 𝐬𝐻𝐵𝐺, and I'm out.